more often than not, we tend to hear about it more from professional services. People who are those self-employed, those disregarded LLCs that are just out there hitting the ground, making as much money as they can from their own hard work type of mindset. The number one thing they hear about is if I convert to an S-Corp, I can save taxes. But what the key to understanding is not saving income tax. It's saving and controlling how much you pay in employment taxes.
Right.
That's the whole point of it.
It's a one-page form. It is an election. So you're still an LLC, but you are electing to be taxed as an S-Corp. When you change to an S-Corp status, you might make your salary $50,000, which makes, so you don't have to pay FICA taxes on the other 50. So it has the potential to save, it saves me thousands in taxes every year. So I definitely recommend it.
Welcome to the Unconventional Investor Podcast. I'm your host, Michelle Moses, certified financial planner, licensed realtor, and founder of Me Financial. If you're an accredited investor feeling overwhelmed by managing your portfolio and looking for alternative investment strategies that go beyond the traditional stock market, you're in the right place. Let's head into today's episode so you can start taking control of your financial future.
Hello and welcome to the Me Financial Podcast. I am Michelle Moses, your host. I'm a certified financial planner, realtor, and former e-commerce site owner. And I think today, if you are a business owner or have an LLC, this topic might be very beneficial to you. We're going to be talking about S-Corps and how electing this tax status can possibly save you thousands in taxes. Why someone would change their status to an S-Corp, the pluses and minuses of changing your status, and how and when to do it. So to discuss this, I have Jared Van Arsdale, CPA, on the show. And Jared specializes in tax compliance, planning, and examination representation for individuals, estates, and trusts. He provides business and tax consulting and is a partner at Ullman & Company here in Phoenix, Arizona. Welcome.
Yeah, thank you for having me.
Thank you so much for taking the time to be on here. Jared and I have talked many times, but we've actually never met in person until today. Yeah. We're always talking on Zoom about different clients and things. And I had you on because every time I talk to you, you have something like a bit of knowledge that I've never, ever heard from anybody else.
Yeah.
So I just want to give you kudos to that I talk to other people and then you always just have something. Yeah. Whether we're talking about 529s or I-bonds or something, you just always you're very knowledgeable.
Yeah, there's plenty of examples where people make mistakes and you learn from those quickly.
Yeah, well, you're very, very knowledgeable, and I appreciate having you because I think a lot of people that get their taxes done, they understand they're always looking for like a CPA to come up with ideas and to, come with tax strategies. And a lot of times it's just like a plug and play for people getting their taxes done. And so I appreciate you and the way that you brainstorm and try to problem solve. So, yeah.
At the firm, we try to do our best to make sure that we're aligning people's expectations of what their actual goals are and not necessarily income tax savings, because income tax savings is a one-year issue.
This is a whole nother reason I like you. Yes.
Yeah, there's plenty of other things on the horizon and over the horizon that you definitely want to think about when you're looking at S-Corps for sure.
Yeah. And taxes aren't straight. And that is another thing, like when you're planning, it's not always just about saving taxes. Like some people will be like, oh, I got to give all this money away. Well, I'm like, well, you don't always need to, spending money is spending money just because you're saving taxes. I mean, you're still spending money. And so you're one of the only CPAs that I know that is like, I don't know that you need to spend that. You agree with me basically. Whereas other people are like, no, you just need to save as many taxes as you possibly can. Yeah. And that's just like the total end goal.
One example I constantly use with clients is when you have a demand for a reduction in taxes, you're needing credits or deductions, but you're always giving up something in exchange. 99% of the time is cash. Mm-hmm. It's like, I'm giving up access to my cash by retirement deferrals. I'm giving up access to my cash by making large charitable contributions, whatever it might be. You're usually giving up something in exchange and you're getting just a piece of it back from the tax code. Right. But you're still giving up the entire lot.
Yeah.
You give a $50,000 charitable contribution. You're only getting maybe a third of it back.
Right.
But you're still out the 50.
Right. Yeah. That's a great way to look at it. Yeah. And that sometimes there's a reason that the saying is cash is king. Right. And so sometimes it's just nice to hold on to your cash. So
sometimes.
So anyway, we're not going to be talking about that. We're going to be talking about S-Corp status and how you elect this. So let's start at the beginning because I think a lot of people are LLCs or they're 1099, kind of employees, if you will. Mm-hmm. And so so how do you explain this to people? Do you have an easy way that you would explain this to people?
The easiest way to think about it is that, well, first, let's take a step back. The S-Corp's been around for quite a while, right? And so more often than not, we tend to hear about it more from professional services. People who are those self-employed, those disregarded LLCs that are just out there hitting the ground, making as much money as they can from their own hard work type of mindset. And that's where most of these small S-Corps come from, right? And the number one thing they hear about is if I convert to an S-Corp, I can save taxes. But what the key to understanding is not saving income tax. It's saving and controlling how much you pay in employment taxes.
Right.
That's the whole point of it.
And by employment taxes, you mean Social Security and Medicare.
Yeah,
right? Okay,
exactly. So,
and so that you guys know, it is is it 14.7 or 15.7?
15.3.
It's 15.3. Oh, I was totally okay.
Yeah,
Not totally off, but it's close.
In the range.
So it's 15.3% of what you make is what you're going to pay in your employment taxes, and we often call it FICA taxes. You might hear people say that too.
Yeah. So as a self-employed person, you're paying the full 15.3 on net business income, regardless of other deductions, right? So the issue is that when profitability isn't substantial enough where that 15.3 starts getting really uncomfortable, people start thinking about this S corporation election. And we could talk about the logistics associated with it, but long story short is it's not completely eliminated. Well, it's not supposed to be.
Right.
But it's within control. So you have to choose, as an S corporation, you are no longer self-employed. You are employed by your own corp.
Right.
And that corporation has to pay you a wage. Now you get to choose how much of those employment taxes you pay versus paying it regardless on the total net income from the business.
Right.
That's where the benefit is being derived from the employment perspective.
Okay. And then the way that I describe it too is so you come up with how much you're going to pay yourself or the business is going to pay you, and you're paying the employment taxes on that.
Right.
But then when you make money over and above what you were paying yourself, then you're taking that as a distribution because you are the owner of the company.
Correct.
Is that the correct way to describe it? Okay.
You have the rights to the profits in excess of a compensation, right? The service doesn't define compensation. It doesn't define exactly what it is. That's where your risk comes in as an employer. You have to define what reasonable compensation is. But the excess profits are there for the distribution. Well, we'll give you one good example where this works out really well is that typically with like high net income earners from healthcare, think of physicians and stuff, this works out fantastic because typically their rate of billing is quite in excess of what a reasonable salary would be for their same services if they were employed by a hospital.
Right.
And they can take advantage of the profits, right? The issue is that when people set that salary too low and they still take out all the profits and they're intentionally avoiding
that is my other
taxes.
question is I feel like people get audited because they set their income at $30,000 or something that's completely,
There's a case I remember, I always like to reference it because it was a CPA who got a little over his skis.
Yeah.
It was somewhere on the East Coast. I can't remember exactly where it was, but he had set his salary at $1,000 a month.
Oh my gosh.
$12,000 a year.
Yeah.
Right? Where his office manager and the other people in his office were making 10 times as much as he was, in regards to other professionals in the office. And he had done this for like a decade before the service came on to him. And then they went back and effectively reassessed and said, everything that you took out of the company as profits is actually salary to you. Mm-hmm. So we're going to reassess, we're going to assess the taxes.
Wow.
And now, great, congratulations, you not only have gross negligence penalties associated with purposely reporting income, but you also have trust fund penalties, which is associated with employment taxes, which could be very substantial.
Exactly. So, lots of penalties. You don't want to get audited and have penalties.
On the employment taxes in particular. Trust fund taxes, think of it like if you employ somebody, you're required to withhold money from their paycheck and give it to the IRS and Department of Revenues and things to that effect. Well, if you take money from them and just simply don't remit it to the state or the government, those penalties can be upwards of 100% of the actual amount of tax. So they're designed to be incredibly punitive because you're effectively stealing from the employee.
Right.
Well, in this case, you're your own employee.
But you're still stealing.
Still subject to the same penalties.
Right. Okay. All right. And so I think, that first part is very important, I think, of not setting your salary too low. And I think it's also important to point out that the distributions that you're taking, you still are paying income tax on that. So when you look at your taxes, you're still going to be effectively kind of making the same amount as you were before. It's just that you've taken out that 15% on a portion of your income.
Yeah. So as a self-employed person, it's like income minus business expenses equals net income, right? The whole thing. When it says an S corporation, you have two pieces. You have the wage portion, which comes in a number of W-2, like you're working for somebody else.
Right.
And then you have the K-1 portion, which is the schedule that your income flows through on the separate corporate tax return, which is the profits portion.
Right.
I mean, the key to understand is that you don't have to take the profits out. And that's actually one way to minimize the examination risk is by leaving the excess profits in the company.
Oh, really? Okay.
But if you leave any profits in the company or you take any profits out, those profits are taxable to you regardless.
Right.
Right. So you're still paying income tax.
Even if you're just leaving it in the account.
Yeah, even if you're leaving it in the account, but it's still coming
because
out
you earned it that year. So I mean that makes sense.
Yeah.
But if you're not taking it out and putting it in your personal account and then spending it.
Yeah.
Okay.
Yeah, the examination risk of the service will challenge when people take distributions from their corporation, the profit distributions, and intentionally do not call that salary, right? But if you never take the money and it stays inside the corp, right, they have nothing to reclassify.
Okay, so that's why it lowers the examination risk. Okay, and so do you think that they're going through and flagging people that, like, hey, they're only paying themselves $30,000? I mean, do you have any insight on any of that?
It's more often when that line is zero.
Okay,
it's when it's like a slam dunk.
Okay,
because obviously zero is unreasonable.
Right.
When it's a small amount, it's subject to facts and circumstances. And example is like say it's a professional firm like an architect, right? And the managing partner is the only shareholder, right? The only officer, but he's retired. And he's just board of directors type of services, right? And collectively the group says, you know what, we still need him, so we'll give him a really small salary. It's called that $1,000 a month again. But he's not providing any services to the company. He's only getting profits because he's the owner, right? Everybody else is doing all the work. Well, his salary is not unreasonable for in exchange for the services that he's providing. So it's subject to facts and circumstances.
And so that kind of stuff is always where they don't want to get
when
into.
It's zero,
they want more slam dunk kind of cases. Okay.
Yeah, when it's zero, it's unreasonable and it's easy.
Okay.
Yeah.
All right. Okay, so if this is something, if you're a business owner and you think that this is something you would want to do, the way to elect it is to file a form, and I always get the number wrong. Is it 2553?
You got it.
Is that right?
Yeah.
Okay, I always get the numbers mixed up, and you have to have it in by March 31st, correct, of the year?
Yeah, so there's a retroactive option where you can have it by March 15th, 75 days after the year end, to retroactive it to 1/1 of the calendar year, or any time in the future associated usually around the 1st. But the only exception to that is if you have a brand new company. You set up a new company and you immediately incorporate it and make an election. You can have the election at any point during the year. But it's if you have an existing entity.
And we were doing it right now, like in October, it would be for 2024.
Yeah, more often than not, it's elected 1/1.
Right.
Exactly.
Okay. But if we were in the year, so this is what I did was whatever I was in the year, did it by, in February when I was doing my taxes, and I did it retroactively for the year that I hadn't done my taxes for.
Yeah.
So,
so there's late relief exemptions where you can go back into the previous year. There's a revenue procedure. Don't quote me. I don't remember the number off the top of my head. I always have to look it up. But there's a couple revenue procedures that allow people to say, you know what, I've been operating like as if I were an S corporation for this entire year, and I just realized I had the paperwork and I had it certified mail, and I just didn't send it. Type of thing. They have late relief standards to let people qualify retroactively.
Oh, okay.
But there's specific criteria.
All right.
It has
to
be,
really get your stuff in. Just do it.
It has to be really not intentional.
Yeah.
Like I figured it out 14 months after the fact, and now I want to go back.
Okay. Yeah.
It has to be like I literally did all the work. I worked with the attorney or whoever I was working with.
I just didn't file this one little form.
Exactly.
And the form is one page. I mean, it's like one page with some disclosures.
This is my accountant coming in. I think it's actually 6 pages.
Is it?
With a bunch of questions and stuff like that, but most of it doesn't apply to everybody.
Right.
So usually it's just the first page with the signature on the second page. Right?
And I think that, so there, for the people that are just working with tax preparers and, they don't have your expertise, I do feel like it's a form that people can fill out themselves.
Yeah, I have a number of
It's
clients
very,
that fill out the
yeah,
forms.
it's very, very simple. So you can just go and search up, how to search up the form, and it's on irs.gov, and you download it, and then you just mail it in. And what I have been hearing is the IRS is not mailing out letters to say that they accepted it. This is why I send it certified mail, so that you know that they got it. And I never got a notice that I was accepted to do it. And this was quite a few years ago.
Yeah.
And it's still kind of going on. So
They're supposed to.
Yeah, they are supposed to. They used to. But you can call the IRS wait on hold for a while to make sure that they got it. But I just went ahead and I started doing the S-Corp, and it was fine.
There's a little bit of risk associated with it. Usually you get a letter in the mail saying your election's been accepted and here's the effective date of it.
Right.
Sometimes when the form isn't completed correctly, the effective date isn't the date you actually chose.
Okay.
And they'll move it out a year or something like that. And so
okay.
you want to be double checked, because if the effective date isn't the date that you wanted, you try to file an S corporation tax return that year,
that it'll be rejected.
It could be rejected.
Yeah. Okay.
Right? Or could cause problems.
Right.
Exactly.
Okay. Okay. So the best case scenario is you want to know that they accepted it. But anyway, it's a 1-page form. It is an election. So you're still an LLC, but you are electing to be taxed as an S Corp. So when you're an LLC, all of your income is coming in. So let's say you made $100,000. All of it is subject to FICA taxes. All of it is subject to income taxes. When you change to an S Corp status, you might make your salary $50,000, which makes so you don't have to pay FICA taxes on the other 50. So it has the potential to save. I mean, it saves me thousands in taxes every year. So I definitely recommend it. And I feel like if people are making over like $50,000 in their business, it's something that they should probably take a look at. That's kind of the threshold that I tell people. Yeah.
I usually tell them something, whenever there's profits in excess of what you think is like the reasonable wage out there for those same services, so it has a higher threshold for like physicians.
Right. That's true.
Physician is going to set a salary of $50,000 because you go work at the local, family practice and make more in that part-time mindset. But certain professional services that are, relatively new. Yeah, absolutely. There's definitely a lot of like flex in the determination of what
your salary is.
And where you want to be like risk examination free is usually when you set that salary at or above the Social Security threshold, because then if the service examines you, they already got all the Social Security taxes, which is 13.2% of that 15.3. So they can only examine you for the additional Medicare tax.
What's the threshold? What is the threshold on Social Security? It used to be like 90.
It changed by so much. It went up so much by inflation.
Did it?
It's like 160.
Okay, so 106 or so. Okay,
so usually, usually, like when I talk about like high income services, like law firms, physician practices and architectural firms, typically the salaries are well in excess of that, and you like eliminate most of the examination risk in an S corporation. Okay. When you have these small disregarded entities, like you have these small landscaping companies and things like that, you start getting a little squishy around what a reasonable comp is, because then the services, are definitely valued differently depending on the size of the company. Yeah, exactly. Right. Okay. All right. And then I think another thing we should point out is that if you do elect this status, is that your taxes will change. You will start to do more of a business tax return, and then that business tax return feeds into your individual tax return. So your preparation costs and the professional fees that you pay to your CPA could go up. I don't find it any more complicated to keep track of anything, from before I was an S Corp to after. That's all the same. It's just that the cost of paying your CPA to actually prepare your taxes is higher and a little bit more complicated. Another reason you do that kind of cost benefit analysis, the cost of administration, the cost of having the S corporation in existence, there's a cost to it, and therefore you want to make sure that the value you're receiving from the planning strategies exceed that. Right. Yeah. Just don't elect into it just to think that someone told you this is what you need to do, and then it ends up costing you a few $1,000s, and you're just like, well, that didn't save me a dime. Exactly. Right. Because if you set your salary at 40 and you're only making 50 in your business, then it's not really worth it. Right. Yeah. And so are there other like do's and don'ts that you feel like are little things that might come up that I'm missing besides this? Because I feel like you elect it, you're still keeping track of all of your expenses and income the same way.
you still give it to your CPA the same way, and then your preparation fees might be a little bit more.
Yeah.
But then you do have to file your quarterly. So I guess that is another thing that comes up, is you really need to do your payroll at least quarterly. And that, so you're paying quarterly payroll taxes and your estimated taxes at the same time. So you want to make sure that you're prepared for that. But normally your CPA will just send that to you, and then you sign it and mail it in. So it's not, I don't feel like it's a huge, burden when it comes to, what am I trying to say? Like bookkeeping and all of that.
But you're also a little bit more analytical.
That's true. I am. It's not that big of a deal for me. For some people, it's a huge deal.
The adding more complication to some folks' lives isn't necessarily the best strategy.
Right. Okay.
When they're busy with kids or whatever it might be, adding one more thing to the calendar every quarter, some might set them over the edge. So you definitely want to make sure it aligns with what they're expecting. And as long as the savings is high enough, you could typically find a way to administer it. You hire a payroll service company.
Right.
Don't even worry about the payroll.
I know. I feel like that's what most people do, is they just hire a payroll company and
for sure.
And then they just send it automatically.
Yeah. So some of the don't. So one thing to remember is that S corporations have significant limitations on who can be shareholders. Mm-hmm. So you definitely want to make sure that is aligned. And usually we see that become an issue with companies who are actively raising capital from outside investors. S corporation is definitely not
right, because you're not selling any of the stock ever or anything like that.
You have issues associated with distributions. You have issues is that I want to raise capital from this investor, but he wants to hold it through his C corporation. Well, that doesn't work because it's an uneligible shareholder and it blows up your S corp. And everything becomes a problem. So just trying to keep it simple. Is that there's limitations on who can be shareholders. Right. There's issues if you have multiple companies. Multiple shareholders, multiple partners in this LLC. You have equitable distribution issues. Say, for example, we had the same firm. We're 50-50 partners. We decided to take $100 distribution. You have to get 50. I have to get 50. Regardless of my being on disability for the 6 months, I'm getting 50 still.
Right.
Regardless of how equitable you might think that is, that's one of the limitations of an S corporation.
Okay.
You have to have equitable distribution.
So a lot of it is what I kind of hear you saying is that when you have a simpler setup,
for sure,
then the S Corp seems to be beneficial. But once you start to get a little bit more complicated, you need to start looking at other
you start
legal entities.
Anything that you start adding a bunch of tools and you add a qualified retirement plan to it or anything, you need group health insurance for the employees. Everything gets a little bit more complicated when you add another entity in the middle between you and it,
right?
Type of thing. And so more commonly we see S corporations with professional services, entities with single shareholders, regardless of the type of enterprise. Like think of large construction contractors or retail agencies. They tend to have really simple ownership structures,
right?
Small businesses, but regardless of sales, right? They typically can be in an S corp with some minimal issues. Where you see problems arise is usually entities that have many different owners, partners, regardless of who's providing services or not. Usually
I can't imagine doing this election when there's lots of different,
because usually when you think of, a lot of small businesses don't pay the attorney to draft an operating agreement, but when you have multiple partners, you definitely have one, or you definitely should have one.
Right.
And think of it like your premarital agreement for a business, type of mindset is that's what it's designed for. And the terms within that could blow up your S corporation election. So there's just a lot of little pieces when you start adding complication into it. And one of the number one things we definitely tell clients to avoid is holding real estate in S corporations. That is definitely not.
I've never even heard anybody wanting to do that.
Yeah.
Really?
Yeah,
okay.
It happens quite frequently. It's because more often than not, it's like we have a existing business. And that business needs a real estate, or wants to purchase real estate. All the cash is here, so they want to buy the property here. And we definitely have to try to convince them, it's like, no, hold that real estate outside.
Outside in a separate LLC.
If you have the ability to, definitely want to.
Right.
You lose some flexibility with being able to do something with that property later that's other than selling it.
Oh, that makes sense.
Yeah.
Yeah. Okay. Yeah. Well, and then you would have the property in an LLC, and then you would pay rent, and you
Right.
kind of run it like that,
We're
right?
adding more complication.
Yeah, it is more
Right.
complicated, but it's also a good write-off for the depreciation, and you're an expense for your business that you're kind of paying yourself.
Yeah.
So yeah. And a lot of times what I see with the S-Corp is the doctors and physicians and things like that. And then what we do, and this is kind of getting out of the scope of what we're talking about, but we do an individual 401k. So they have an S-Corp, and then we have an individual 401k. And so that might be something that you guys want to look at if you do have a business. As long as it's just you and a husband or wife, you can have an individual 401k. So if it's just a real simple LLC, then a lot of times that's what people have set up. And then I just see you can really supercharge your tax savings that way. Yeah.
Using any qualified retirement plan.
Yeah.
To create a large 401k is usually pretty simple.
Yeah. The individual 401k though is so simple to set up, and it's so simple. You can get so much more money in there. Let's put it that way, versus like a regular IRA or a simple, you can just get a lot more into the individual 401k. So, okay. So we talked about best types of business. And then what about exit strategies? Is there anything that you have to worry about? Like when let's take me. Okay. So let's pretend I'm older and I'm an S-Corp and I'm going to sell my business. Is there something to worry about when I'm trying to exit my business or anything like that? Or what do you see?
Yeah. So when you're creating an S corporation, there's only two means of removing yourself from it, right? Or let's say three means. The sale, which I'll come back to that. There's the succession, bring somebody else in and let them effectively take over, redeem your ownership or whatever it might be. And then there's just a straight up liquidation and close the company.
Okay.
Right. And what we see sometimes with like example, captive insurance company that decides to be an S corporation. Well, those captive insurance companies can't sell their books of business. So they're almost forced to liquidate because they have nothing to sell.
Right.
Right. Or they have an employee that's willing to take it over for them, and they can kind of transfer it over and hopefully still retain some value for themselves. But more often than not, you see these small businesses just liquidate, close the bank account, close the entity, be done. That's quick and easy. But more often than not, people don't start a business with the intent of simply just wrapping it up,
right?
Type of thing. They're looking to create some value and then sell it to fund their own retirement plans or whatever it might be. So one thing to think about when you have an S corporation is if you're planning on selling this entity, if it's your overall long-term goal is to sell to a third party, typically you have a little bit more due diligence in the sale. I've seen it more often with private equity buyers is that they'll have a lot more, they'll bring in specialists for S corporations to verify the validity of S elections, regardless of how far it goes back. They go through years and years of tax returns to make sure there's no instances where you could have accidentally invalidated your own S election.
Okay.
And they just push you through a ringer.
Because that's really important because if you didn't have it and they purchased the company, then they could be on the hook for it.
Well, what ends up happening, if you invalidate your S election at any point in time after you made it, you default to a C corporation.
Oh, really?
Substantially worse.
Yeah.
You don't get to go back to your comfortable self-employment life
right.
At that point. If you invalidate the S election, little background is that when you prior to this, the 2553 election, we had to go through another form, make an entity to be classified as a C-Corp, and then you'd make a second election to be classified as an S-Corp. It's a small business corporation instead of a regular. So you had to do a two-step process. Well, a while back, the service created this like check the box rule where you could just simply jump straight to the S-Corp and save them some processing power. Right. And those laws still exist. So if you invalidate your S election, you convert to a C-Corp.
Oh man.
And you end up subjecting yourself to double taxation because the C-Corp pays its own taxes. And if you ever take any money out of the C-Corp, you pay taxes on that distribution as well.
Right.
So it's really, really detrimental.
Well, and let's explain what C-Corps are real quick here. Like, cause C-Corps would be, more what you're thinking of, Microsoft, Apple, like these huge companies that you guys all know, those would be more.
Yeah. Typically they're used for people who are raising capital from outside places.
Right.
That's where they're most common.
And then there's stock issued. Yeah. And then there's stock issued, but it's a lot. That's more complication than most people need.
Yeah.
Yeah.
For sure.
Okay.
Yeah. So just that's what they're coming through. When you're going through like a sale of an S corporation, those the buyer is going to should put you through the ringer to verify the validity of your selection, or they're not going to buy the entity. They might buy the assets, right, and leave you with your own company. It's like, hey, you know what? You have a book of business, right? We'll buy the book of business, but you get to keep your company and all the mess you created in the past, and we'll just take the assets and we'll give you a check for it.
Okay.
Type of mindset. That works out really well, and then you can just wrap up and liquidate the company and move over. Less common is the kind of the succession plan where there's intent to transfer entity ownership to employees, and that's a little less common. It happens a little bit more in professional services when there's like a group of physicians where they have a long list of partners, and they can just kind of slowly allocate it to the younger generation of physicians that are being added back end.
Right.
That happens a little bit, but more often than not, those are still formed as partnerships. But
Okay.
Just keep in mind is that the most common intent is sale. But if you plan on selling the company itself, there's a little bit more time and hassle associated with it.
All right. But for somebody like me, I could sell my book of business. They wouldn't necessarily be buying the company. Correct. It would be buying a book of business.
More often than not, if I'm the buyer, I typically want to buy the assets.
Yeah.
And the reason is because I don't
You don't care about the business or the name necessarily sometimes.
If the week before you ran over one of your clients in the parking lot and the company now has a huge unstated liability or risk of future litigation,
right?
I don't want to buy your mess.
Yeah.
Right. I typically just want to buy the assets and the future profits, and that's what I'm taking from you.
Okay.
But sometimes it's unavoidable. Sometimes I'm forced to take the company because I don't want to rewrite a bunch of contracts with customers, or I don't want to rewrite think of like a software licensing company.
Right. They'd have to
need the corporation because the licensing agreement with that software provider or whatever it might be is with that entity, and you can't simply just rewrite that contract.
Right.
Yeah.
Right. Okay. All right. Do you feel like there's anything that we're missing that comes up a lot with the S-Corp election or anything like that?
No, I think we pretty much covered most of it.
Yeah, I think we've covered most of it and kind of the hows of the details of how to do it and everything. So, and I had no idea. See, this is what I'm talking about. I've never, ever heard of going from an S-Corp to a C-Corp if you mess it up. So there's always a little tidbit that I learned from you. So thank you.
Yeah.
So thank you for being on, and leave me a review, subscribe to the podcast, and thank you so much for listening. And let me know if you have any questions. And all of Jared's information will be in the show notes in case you wanted to get in contact with him.
Thank you for listening to the Unconventional Investor Podcast. I hope you feel more confident in how you can grow your wealth using the strategies I shared in this episode. If you're ready to take the next step in diversifying your portfolio outside the stock market with alternative investments, head to mefinancial.net/contact us to book a 15-minute consult call with me. Let's discuss how we can work together to achieve your financial goals. Until then, I'll see you on the next episode.